Welcome back to part 3, investments. We have 4 parts to this, and remember the solutions to the practice problems are on the back of the last PowerPoint. And use the table of contents to switch between slides. For this section, we are going to do the journal entries for stock investments, and we're going to talk about how debt and stock investments are reported in the financial statements. And this is a huge departure from the cost principle, where we record assets at cost. We are going to, this is an exception to the cost principle. Before we can do the journal entries for stock investments, we need to understand just how much of a percentage of purchase that was. So the investing company, how much of the stock do they buy? What percentage? If they buy less than 20%, this is considered an insignificant investment. And that's the journal entries that we are going to do in this section. However, a company could buy between 20 and 50%, a significant investment. This means that they actually have a certain amount of influence over all the votes that are taken, that the stockholders vote on. If a company buys more than 50% of the outstanding shares of another company, this is a controlling interest. When I worked at the Paquette company, they purchased 49 point something % of the shares of another company in Mexico. This was a significant interest, but not a controlling interest. The family that sold it to Paquette wanted to have and keep a controlling interest. Later on, the family agreed to sell additional shares of stock to the Paquette company, and from then on, Paquette had a controlling interest in the Kenworth, Mexico plant. For this class, as I said, you are only responsible about understanding the journal entries for holdings of less than 20%. When do you get to learn about the other 2 types of transactions? You will learn those later on in accounting. If you major in accounting, you can certainly read about it in your textbook. The accounting is a little different. Okay, what makes the holdings of less than 20% particularly easy is that they're accounted for similarly to debt investments using the cost method. Companies recognize the investment at cost, and they recognize revenue only when the cash dividends are received. And cost, similar to debt investments, include all expenditures necessary to acquire the investments. So whatever price they paid, plus any brokerage fees. So we're going to do the journal entries for the acquisition of stock investments. We're going to do the journal entry for dividend revenue received, and the ultimate sale of stock investments. How does this differ from debt investments? We still had the acquisition and the sale, but we don't recognize interest revenue, but rather dividend revenue. And Chapter 12 is all about whether a company has extra cash. They can't really be making these investments if they're a startup company, but we assume these companies are in a good cash position. So let's take a company. The Cayley Corporation acquires 1,000 shares, 10% ownership. So that's a big flag right there. They're telling you it's less than 20%. You will be using the cost method of Cayley Corporation. Sanchez pays $40 a share plus brokerage fees of $500 plus. Now in my debt investments example in part 2, it was including brokerage fees. When I say plus, that's additional cost to the $40 a share. So we have stock investments, $40 a share times $1,000 plus the additional $500. And you see cash going out, credit $40,500, and we have a new account, stock investments $40,500. Stock investments is an asset account just like debt investments is. Normal balance, debit. All right, let's move on to the good stuff, the dividends. That's why we bought this stock, it appears. So Sanchez owns the stock, and it's going to record the cash dividends it receives. So let's say on December 31st, Sanchez receives a $2 per share dividend. Now when you see that word receives $2 per share, receives means cash. So cash goes up $2 a share. times $1,000, so they got $2,000 in dividends. And we're going to credit a new account, dividend revenue. Dividend revenue is a revenue account, just like interest revenue, and it will reside on the income statement. Cash resides on the balance sheet. Dividend revenue will be in this section on the income statement, other revenue and expenses. Okay, finally, let's assume Sanchez Corporation sells its stock. They're selling it for $39,500. Now, the stock cost Sanchez $40,500, so you can see they lost $1,000 on this sale. But we have to clear out the stock investment account at its cost. So that's what we're going to do. We're going to show the cash coming in, and you're going to see the stock investment going out for its original cost, $39,500 here, $40,500 here. We need a debit to balance this journal entry, so we know it's a loss. Losses, normal balance, are debits. Any type of loss account has a normal balance of a debit, just like expense accounts. And be sure to put that full title there, Loss on Sale of Stock. And remember, for my tests, please put a journal description under each journal entry. Okay, let's practice. Frank's Produce. And if any of you like to go down to Pike Place, there actually is a place called Frank's Produce down at the market. Frank's Produce conglomerate had the following transactions pertaining to stock investments. Now use your course pack for this. Use a pencil, log these journal entries, and then at the end of the last PowerPoint presentation, your solutions will be posted. I post the solutions. So let's just walk through these journal entries, but I'm not going to give you the solutions here. We purchased 500 shares of Jordan Company common stock, 2% ownership position for $5,000 in cash, plus brokerage fees of $250. That means it's not only the $5,000 but an additional $250. Now note that 2% ownership position, that's just flagging you that this will be using the cost method. July 1st, received cash dividends of $1 per share. So you're going to recognize that cash coming in. Sold 250 shares of Jordan stock for $3,000, less brokerage fees of $75. Now you're going to go back and look at February 1 and say, what percentage of sale was this? 250 on 500. And you're going to divide this $5,250 proportionally to this 250 shares. Finally, you're going to receive more dividends at the end of the year, but again, it's only on the remaining shares because you've sold 250 already. So stop the video, take a second, and do those journal entries.